If you haven't already noticed, interest rates are going up. And this is possibly a life-changing moment for many Canadians, specifically if you have a large mortgage, because it is almost certain that in the future, when you go to renew your fixed rate mortgage, or maybe it's happened to you already if you have a variable rate mortgage, that your payment is going to increase. You see, we went through a period from probably about 2009 through the beginning of 2022, where most of the 5-year fixed rates were well under 4%, except for maybe a brief period of time in 2018 and maybe the beginning of 2019 when rates started to flirt with that 4.0 mark. But now with loose monetary policy coupled with low interest rates for like 2 years, national financial regulators are signaling that increased interest rates are here to stay. And well, we haven't seen increases like this since the 1980s. And the market didn't do so good back then. So now it's your job and mine to make sure we switch our focus from taking advantage of a great economy with leverage and growth to a mindset of saving and planning for tougher times, because we could be headed into this high rate environment for who knows, maybe a decade or more. And just last week in this video, I showed you where hopefully you can start saving a little bit of money to prepare yourself for the next financial phase of our economy. And now it's time to show you in this video some of the benefits of paying down your mortgage a little faster with whatever savings you have. Because I sell homes for a living, and that means most of my clients are taking on between 25 and 30-year mortgages when they buy a home. But I'm not, and never really have been, someone who likes debt. I don't preach to leverage up, and I'm a relatively financially conservative person. I work hard every day to pay down my mortgage a little faster than the schedule that the bank has set up for me. And hopefully I can share some information with you today so you can see the benefits of doing the same. But before I show you the positive effects that may result from paying off your mortgage just a little bit faster, I'm going to ask you to please go ahead and subscribe to this channel so you can stay up to date on Surrey and Fraser Valley real estate. And if you've managed to scrape up a little bit of extra money and put it down in your mortgage, go ahead and give yourself a big thumbs up. Because at the same time we're celebrating your financial responsibility, you clicking the like button also helps me get this information out to other people who could really benefit from learning more about their finances. So thank you for that. And now on to the video. All right, I wanted to analyze some of the benefits you can have from paying down your mortgage a little bit faster with whatever you have available to put down on your monthly or biweekly payments. And I have to start off this video by acknowledging that these calculations do not adjust for the Canadian way that mortgages work, which is that they likely readjust every 5 years or less. So if you know of a mortgage calculator that does adjust for possibilities of changes in your interest rate when your term expires, please leave a link to it down below in the comments. And well, I think we could all really benefit from something like that. But what I did do was just type into Google mortgage repayment calculator. And well, I ended up with the very first one on the list, which is calculator.net. It's called Mortgage Payoff Calculator. I encourage you to do this with your mortgage from the day you got it, or maybe what your future balances will be. I think you'll be in a much better spot if you do. So I've got a bunch of notes here. I wanted to calculate what I figure was probably a very realistic mortgage for a lot of people earlier in the beginning of the year. And I've done this on a 25-year payment. I do understand that some people do 25-year payments, and because they're CMHC or not, some people are just financially responsible, do 25 years anyway. But I went with a $700,000 mortgage with a 25-year repayment at 2.79. Earlier in the year, I would figure that this would be a very typical mortgage for my area here in Surrey. If you were buying anywhere between a $950,000 and $1.5 million house, this is the type of mortgage that I saw most often. So if you just go down and click the calculate button, you'll find out that your monthly payment is likely going to be let's call it $32.50. It's a little bit less than that each and every month. Now, this is what I love to focus on, is this little section here. It calculates out the interest that you're going to pay and then the total repayment. So you've borrowed $700,000. If you keep this for 25 years, if you were to get this interest rate for 25 years, and again, this is the flaw in the calculation, so I will acknowledge that, you're going to pay back over $250,000 in interest. And well, you're going to end up paying back that on top of what you already owe. So you're buying a house for whatever amount. Your mortgage is $700,000. You're paying almost $1 million for that home. Another cool thing this website does is, well, it's got a pretty cool little amortization table, and this is going to be likely the most useful tool. So if you click that little button and then scroll down, you're going to be able to go to the end of year 4 or your 60th payment. You're going to find out how much principal and interest you're paying on each one. But then you also get to calculate what your balance will be on your loan after the 5-year period. So this is really, really important because we're going to mess around with a few numbers. What's really cool about this website is it allows you to look at what happens if you paid down just $100 extra per month. So $25 a week. How much would you save? So you can type in whatever number you want here, but I used $100 because obviously life is getting expensive. We don't all have a ton of money kicking around. And you're going to calculate that. And this is kind of the coolest part. First off, it comes out and tells you immediately that you're going to pay your mortgage off 1 full year earlier for sacrificing $100 a month. Again, I do understand this is if you get to keep that $279 payment the whole time, which I don't think you will get. But bear with me here. As a result, over the lifetime of the mortgage, you're going to save yourself almost $13,000 in interest. So that interest payment is otherwise in your lifetime would just be gone. So that is a massive savings. But that's not what I want to focus on here on this particular video, because when your 5-year period does come up, if you locked in for $279 earlier this year, I think your life is going to change pretty dramatically when you see where the payments are in the future. So what I want you to do is look at how much can we save right now. Well, what I did was on my scrap of paper here, I went and calculated this ever so slightly different using the amortization table at the end of 4 years. And I found out that including the extra $6,000, so you have now 60 payments, and you're putting in an extra $6,000, the difference in your balance would have been $596 previously and is now $589. Now you have to scale out that extra $6,000 because you did put that money down. And the actual interest savings by the end of that term, if you just increase your payments by $100 per month, is an extra $430.65 that you don't have to pay in interest. Now, I understand that at this interest rate is not a lot of money. It's not a ton of savings. You're paying off a year earlier. However, there is something that I think most people should do, and particularly if you receive your paycheck on every second Friday instead of the 1st or the 15th or the 1st of the month. If you receive your check on every second Friday, I'm going to recommend that you move your payments to bi-weekly. So you will get an extra 2 payments per year. I'm going to hit that calculate button. Immediately, you can find out that you can save yourself over 2.5 years on your now 25-year mortgage. So instead of being 25 years, we're just over 22 years. And as a result of, in this particular case, again, if you kept $279 for the whole period of time, you're going to save yourself $30,000 over the next 22 years. But let's focus again on what it looks like after 5 years. Remember our remaining balance originally at the end of 4 years was $596 and change. Well, now that number is below $580 because you've now increased your payments. Now, the reason you've increased your payment is actually not that much different, but you're making 2 more payments a year, and those 2 more payments a year add up to basically 13 months instead of 12 months. So after you calculate that for the period of 5 years, your actual payments have increased by $16,000. So that's what the big difference is in your actual remaining balance. However, you have saved yourself $1,063.30. I know it doesn't sound like a ton of money, but just bear with me because interest rates have risen. And well, let's take a look at what it looks like if you were to buy that property then, and then that exact property today. Or should I say If you qualified for a $700,000 mortgage at 279 then, and what you would qualify for today. So my broker over at Citywide Mortgage Services tells me that roughly, let's be rough here, but you were qualifying previously for $700,000 at 279. Likely now you will be at 553. And today's interest rate, if I'm not mistaken, is 5.54 in most locations should you have 20% down. I'm going to go back to a normal payment schedule and have it calculate for me. And my mortgage payment, I don't know if we focused on this. The previous mortgage payment was $32.43. Now, if I qualify for that much less, and hopefully the house has actually come down that $150,000 or so, $147,000, my payment is now $150 more. At the end of the 5-year amortization period, I owe still $493,000, which is quite a bit, but look at how shocking this number is here. So remember previously, if I could keep that 279 for 25 years, which I know you can't, but if you could, and you had a $700,000 mortgage, you would have paid back, what was it, 275 in mortgage payments in interest. Now you're buying a property that much less at a much higher interest rate, but you're paying back interest of almost as much as your mortgage. This is a $469,000 interest payment over 25 years. But with higher interest, this is where paying down more makes more sense, and this is why I want you to do it. So let's take that same repayment schedule, and we're going to add that $100 extra per month. Immediately, you save 1.5 years off of your mortgage. And this is more realistic that we have a 5.5-year mortgage for, the period of time of let's call it 25 years. It's a much more realistic 5-year trend. You're saving $32,000 for the sake of putting in $100 more per month. And that is just the interest. However, let's look at the amortization table again. I'm going to pop down to payment number 60. You now owe $487. If I did my math correctly on that, you've put in an extra $6,000. You've now saved in the first 5 years $895.14. But if we go back up, and I want you to change your payment just to biweekly. Don't increase your payment. Just make more of them. Make them every second Friday instead of the 1st and the 15th. We're going to hit that calculate button and look at the difference. 3 years and 8 months. If you keep that same rate for the whole period of 25 years, and I guess the caveat there is you do also need to make those extra payments through that whole 25 years. You save almost $79,000 in interest. Let's hit that amortization button again. We're going to look out now. At the end of 5 years, you only owe $474,000. You've now dumped in an extra over $17,000 in payments in that 5 years. However, if you do the math on both of those in your first 5 years at almost just over 5.5% on a much smaller mortgage, you're saving yourselves $2,318.20. But let's face it, on this model, if this is where your interest rate is going to be long term, most people are taking 25 or 30-year mortgages. And think to yourself, would this put you in a position to maybe even retire from that job that you're not so fond of 3.5 or more years earlier? I think it would. And that's probably the biggest benefit of paying down your mortgage more and a little faster for most people, because I don't believe that most people are looking at the overall capital cost. They're thinking, hey, when is it that I can retire? So there you have it. Let me know what you think. If there are better mortgage calculators out there, please share them down below, because I'm sure this is probably not one of the best ones. But I do encourage you, if you have any money left over at the end of the day, please put it onto your mortgage, because mortgage rates are going to be high for what is likely going to be a very long time. And I am concerned now with just specifically interest rates and inflation reports that have come out just within the last few days, that these interest rates are only going to continue to get higher. And a lot of people, including myself, that were budgeting on relatively low interest rates, let's call them 4% over the last few years, well, we have to have a new perspective, and we have to start thinking about not leveraging as much because the economy is not going in that direction, and we have to worry about principal pay down. So pop into calculator.net or one of the other ones you can find on Google and find out where your position is going to be within 5 years, because I think you will find it's going to be extremely valuable, and you can only do better by paying off your mortgage sooner. Thank you so much for watching. Please remember to subscribe, click the like button for the YouTube algorithm, book a call with me if you're looking to buy or sell real estate in Surrey or the Fraser Valley, and we'll see you in a couple of days.